VIP company, a large stock exchange listed company, is evaluating an investment proposal to manufacture product W33, which has performed well in test marketing trials conducted recently by the company's research and development division. Product W33 will be manufactured using a fully automated process which would significantly increase noise level from VIP company's factory. The following information relating to investment proposal has been prepared. Initial investment, selling price in current price terms, which it means inflation will be applicable from the year 1, which is 3%. Variable cost $8 and fixed operating cost is 170,000. Expected operating inflation is 4%. The research and development division has been prepared the following demand forecast as a result of in its test marketing trials. The forecast reflect expected technologies change and its effects on the anticipated life cycle by product W33. These are the units. It is expected that all units of product W33 produced will be sold in line with the company policies of keeping no inventory of finished goods. No terminal value or machinery of scrap value is expected at the start of the fourth year, at the end of the fourth year. When production of the product W33 is planned to end. For investment appraisal purposes, VIP companies uses nominal rate of return of 10% and a targeted return on capital employed per year is 30%. Ignore taxation. Calculate the following values for the investment proposal: NPV, second one is IRR, and the third one is return on capital employed based on average investment. And then we have the theoretical points. So first we will calculate NPV, then IRR, then ROCE. Starting from year 0, 1, in fact, this must be year 0, 1, 2, 2, 3, 4. It should be empty. And taxation is ignored. No taxation is provided in the question. Okay. So we will start from initial investment, which means capex. Capex is what? It is 2 million payable in year 0. It's a cash outflow, so show in negative. Sales revenue is equal to selling price is 20 into units for the year 1 are 60,000. So units are 60,000 into 1 plus 1.03 raised to power 1, which is inflation. Second, for year 2, price is same 20, but units are rising. 70,000 into 1.03 raised to power 2. Third one is 20 into 120,000 into 1.03 raised to power 3. Fourth one is 20 into 45,000 into 1.03 raised to power year 4. Less variable operating cost is equal to 8 into 60,000 into 1.04 raised to power 1 is equal to 8 into 70,000 into 1.04 raised to power here 2 is equal to 8 into 120,000 into 1.04 raised to power 3. Then is equal to 8 into 45,000. I can use copy paste, but I just wanted to tell you that if you want to calculate separately or if you have any confusion, then it is better to calculate separately. Fixed cost is what? It is 70,000 per year, same current price terms. So 1.04 raised to power 1. If I use copy and paste, I think there is something wrong with my right click. So same 170,000 into 1.04 raised to power here 2. Then 170,000 into 1.04 raised to power here 3. Then 170,000 into 1.04 raised to power here 4. Now we will calculate net cash flows. 2 million this minus this minus this. So if yes, it works. So we have present values. Sorry, net cash flows. Now we will do what? We will calculate our present values. Present value at 12%. For year 0, it is 1, so it will remain the same. But for year 1, this multiplied by first year factor at 12 at sorry, it is 12% or 10%. It is 10%. So, so present value at 10%. For year 1, it is multiplied by 0.909. Next is this multiplied by 0.826. This multiplied by 0.751, this multiplied by 0.683. So now we will calculate what net present value, NPV, because I think no scrap value is given. So NPV is what? Is equal to this plus this plus this plus this and plus this one. So almost 367,000 in the nearest $100,000. So this is the net present value. Right, everyone? Any question? Next, we are required to calculate IRR. So for IRR, what will we do? We will pick these cash flows. I am going to copy paste these three lines. At 10%, my NPV is positive. So it means to calculate another net present value, now I need what? Higher discount rate. So what will I do? I will choose the higher one. Like I will pick 15%. I can pick like 20%. So I will choose 20% to calculate the another net present value. Ideally, one net present value must be negative for IRR and one must be positive. But if you have two positive net present values, still you can calculate your IRR. But definitely do not try it with the two negatives. First one is negative, it means this project is not financially viable. So now I am going to change present value factors with respect to 20%. For first year it is 833. The second year it is 694. For third year it is 0.579. For fourth year it is 0.482. So we will once again calculate NPV after this is equal to this plus this one, then plus this one, then plus this one, then plus this one. I think there is something wrong with this calculation. 2 million is negative. Let me check once again. Minus 2 million plus this plus this plus this and plus this. Again, it is giving some incorrect answer. Let me try in another cell. This is in negative. Here, 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 and here. So I incorrectly wrote 13551 here. So that's why I was getting the incorrect or quite high positive NPV. Now I am done with this correction. So now we will get the correct. Yes, 78,345 negative NPV. Now what will we do? We will calculate IRR. You can use the formula of IRR provided here, but I am not using the formula right now. I will write simply lower discount rate, which is 10, plus bracket open highest NPV divided by highest minus minus, it will become plus, or minus, it is already in negative, it will be automatically plus. So bracket close. Multiplied with what? Multiply it with the high and low discount rate, 20 minus 10. So if we add with the 10, 10 plus this, IRR is 18.2%. So 18.2% is the IRR. Anyone, any question? Next is to calculate return on capital employed. To calculate return on capital employed, what will we do? We will add up all the cash flows, or in fact we need what? We need profits. So what to do? We should deduct depreciation every year to calculate the profit. Alternative method is what? Alternative method is return on capital employed total cash flows is equal to these are the total cash flows. Now what to do? To calculate profit, either to deduct depreciation every year or deduct initial investment just once from the total cash flows. This minus 2 million. So you will get the answer. No, uh, like we are using what? This one's 560,000. No, we will not use the discounted cash flows. We will use simple cash flows. I thought you are saying that I incorrectly use discounted cash flows. If yes, then answer is correct. Total cash flows are 3 million. Total operating profit. Next is to calculate average profit per year. Average profit per year. What is the average profit per year? Is equal to this total divided by 4. Next is to calculate average investment. Investment is 2 million divided by 2. There is no scrap value. So ROC capital percentage is So 25%. You can convert into percentage terms either by using percentage sign. So 25%. This is return on capital employed. Any question? Okay. Now we are done with the first part. Briefly discuss your finding in section of A previously and advise whether the investment proposal is financially viable or not. We are expected to calculate ROCE 30%, but we have 25%. So if I look at ROCE, we should not invest in this project. But basically, ROCE is not the decision rule. Decision rule is always NPV. NPV of the project is positive. That's why we should invest in this project because it will maximize shareholders' wealth. Cost of capital of the company is 10%, but IRR is 18%, in fact 18.2%, which is significantly greater than cost of capital. We can alternatively say that company is taking less risk. Next one is targeted ROC is 30%, but company is expected to earn 25%. So on the basis of ROCE, we should not make investment in this project. But ROCE is not decision rule. Decision rule is always NPV, which is positive So we should accept the project. So this is the answer of the part B. Any question, anyone? Next one is discuss how the objectives of VIP company stakeholders may be in conflict if project is undertaken. Okay, so what is the information provided? He is saying that which has performed well, trials conducted recently, research will be manufactured using raise the noise significantly increase noise level of VIP company's factory. Fully automated process. This is the first concern. Second one is forecast effect affected. Next is no terminal value or machinery discovery expected. Where is planned to start for? So the main concern is what? Main concern is like noise level. Okay, one of the student is saying that she wants to see the answer. Yes, do you want to see this part B? So now we are going to discuss part C. What is he saying in the part C? In part C is saying discuss how objectives of VIP stakeholders may be in conflict if the project is undertaken. Mainly it is basically creating noise. This is the main concern over here. Stakeholders are interest holders in an organization. So different stakeholders have different types of interests. Like shareholders wants wealth maximization, but others want peace, or they expect CSR from the company. CSR means corporate social responsibility, and they think that company will not perform any activity which can create noise or any other disturbance in the environment. If company will not accept the project due to noise, so it will not maximize shareholders' wealth. Now it is expected from company's management to make a balance between all stakeholders. So this is the right answer. Done, everyone? Any question? Okay.